You've been told all your life that owning a home is the gold standard of success, and renting is just throwing money away. Well, think again, because a Wall Street Journal report from 2023 revealed that a surprising number of millionaires are now deliberately avoiding buying houses and choosing to rent. Because for them, buying a house is actually a trap that can keep them from building real wealth. So what's the hidden truth behind buying a house? In this video, I'm going to explain the key reasons why the rich are not buying homes, and it might change your entire perspective. To unwind this, let's jump inside. Buying a home is not always the best investment plan, and this fact has already been figured out by the rich. The banks, mortgage lenders, real estate agents, and maybe your uncles have been trying to set a narrative in which home ownership can be seen as an end-all, be-all financial success, with statements like, owning a home is the best investment you'll ever make. Renting is just throwing money away. Property prices always go up, etc. And it's not surprising because organizations like the National Association of Realtors have spent billions convincing us that buying a house is always better than renting. Moreover, if we consider the real estate industry, it generates over $200 billion in commissions annually. That's a pretty strong incentive to keep the buying narrative alive. But we're exposing the real financial secret about owning a house right now. Here's what they don't want you to know. See, we are in 2025, and the math has completely changed. 50 years ago, houses typically cost about 2.5 times your annual income. But today, it is 7 to 10 times in most cities. In places like San Francisco or New York, it's even higher, about 15 to 20 times. For example, your parents might have bought a cool 3-bedroom home for 3 times their annual income decades ago. They have put about 20% down, locked in a manageable mortgage, and rode the wave. But now the US median home price is around $417,700, and the median household income is around $74,580. That's a price-to-income ratio of over 5.6. It's nearly doubled from what it was in the 1970s. Yet we're still being told the same outdated advice from 40 years ago. So, now is the time to follow what most millionaires are doing instead of buying homes. This is what they have been doing. When everyone was FOMOing into real estate in 2021 and 2022, buying second homes, flipping Airbnb, and bragging about passive income, the rich were already quietly listing properties. They didn't get into the lies they've been told. Instead, they made millions of dollars for themselves by investing. The fact is that rich don't tie up their money in things that cost them money. They put their money in things that make them money. Let's look at a real example of buying versus renting. Imagine 2 identical $1 million houses next door to each other. One you can buy, one you can rent. To buy it, you will need a $200,000 down payment, $6,000 monthly costs, including mortgage, taxes, insurance, and maintenance. To rent it, you will need $0 down, $4,000 monthly costs. The homeowner feels smart because they're building equity, but the renter invests that $200,000 down payment plus the $2,000 monthly difference in an index fund averaging 10% annual returns. After 10 years, the shocking truth emerges. Even if the house appreciates 5% annually, the renter who invests differently often ends up with more money. So one thing is guaranteed. Investing money in smart ways can make you wealthier over time. Like if you invest your money into stocks and just let it sit, year after year, you can quietly build serious wealth without the headaches of mortgages, property taxes, maintenance costs, or housing market crashes. And math isn't the only thing that has changed. Let's talk about some of the biggest myths that still keep people locked into outdated thinking. One of the myths is that real estate prices always go up. This is simply not true. And it might be shocking, but the reality is that the real estate markets do crash. And you don't have to go too far to remember this. Yes, like the 2008 housing crisis didn't just take a blip, but wiped out $9.8 trillion in US household wealth. Millions of people lost their homes and savings. In such circumstances, the people who survived are the ones who were on rent. Many didn't recover their house value for over a decade. Right now, not only America, but the whole world is facing a real estate crisis, as the housing markets are volatile worldwide. First is China, the real estate sector, which was once 30% of China's entire economy is now crashing, and major developers like Evergrande and Country Garden have defaulted on billions of dollars in debt. Home prices have fallen for 22 straight months as of early 2025. In Canada also, home prices are wildly unaffordable. As Royal Bank of Canada reported, the average home ownership cost in Canada is now 62% of the median household income, a record high. In fact, a 2024 analysis by Goldman Sachs found that when adjusted for inflation, many U.S. housing markets have had multiple 10-year periods of negative returns. This means owning a home doesn't always guarantee the same long-term financial benefit as 10 years ago. Indeed, buying a house suffocates your money. Myth number 2 is that a house value doubles every 10 years. This is also not true. According to economist Robert Shiller's research spanning 100 years, housing prices have increased just 0.6% annually after inflation. That's nowhere near doubling. And remember, that's before subtracting all those phantom costs. Phantom costs are the hidden expenses that quietly drain your money. These are all the expenses beyond your mortgage that eat away at your supposed investment, like property taxes, insurance, maintenance, repairs, renovations, HOA fees, etc. In contrast, renting provides you with flexibility, a flexibility that makes you free to move for a better job opportunity without having a second thought, and even helps you to live in 3 different cities to support your dreams. Meanwhile, your friend who bought a home is stuck fixing a broken water heater on Saturday and spending every dime on home equity that may or may not show up in the future. Even in global hotspots like London, Tokyo, and Singapore, sky-high property prices often put home ownership beyond the reach of many, and that's where renting shines. By paying a monthly rent, rather than a massive down payment and decades of mortgage interest, residents can live in prime neighborhoods without the long-term financial commitment. One of the wealthiest innovators on Earth, Elon Musk, chooses to rent. Not because he can't buy, but because he sees ownership as a distraction from bigger goals. In 2024, he shocked everyone by revealing he doesn't own his primary residence. He said, "I'd rather put my capital toward Mars than toward maintaining a roof." And he's not alone. Mark Zuckerberg famously rented for years despite being worth billions, because they understand a fundamental truth about wealth. Investing mindfully always pays back. Another reason why the rich are no longer buying houses is that they want to avoid high-leverage risks like mortgages. A mortgage is basically a giant loan you take from a bank to buy a house, and you pay it back over decades with interest. These are not just monthly payments, they are 30-year, high-stakes commitments. Let's say you buy a $500,000 home with 10% down. That's $50,000 up front. Add in closing costs, inspection fees, and moving expenses, and you're likely spending around $65,000 to $70,000 just to get started. Your monthly mortgage payment, factoring in interest, property taxes, and insurance, could easily come out to $3,500 or more. Now, if the housing market drops by 10%, your $500,000 home is suddenly worth $450,000. That's a $50,000 loss in value. But here's the catch: your mortgage is still based on the original price. You only put down $50,000, so your loan balance is around $450,000, and now your house is worth the same or even less. That means your equity just vanished, and you're officially underwater on your mortgage. Equity is the part of your home that you actually own. It's the difference between what your house is worth and how much you still owe on the mortgage. It's like your ownership stake in the house. So, rich people usually don't like big risks tied to debt, especially when an asset like a house can lose equity or value. They prefer to invest their money where it grows steadily and gives them more flexibility, not where a single downturn could wipe out hundreds of thousands overnight. So instead of taking out risky mortgages, many wealthy people rent homes or only buy when they can do it with very little risk. Another setback with buying a house is losing the opportunity of diversification. Diversification of money means spreading your savings or investments across different streams. Let's get real. When you buy a house, you're putting a massive chunk of your money into one thing, one property, in one location, in one market. That's not smart investing. That's putting all your eggs in one basket. Wealthy people know this. That's why many of them avoid buying homes, especially early on. They understand that true wealth comes from diversification, or spreading your money across different assets, so one bad move doesn't wipe you out. Think about it. Would you ever pour $400,000 into a single stock and just hope for the best? Probably not. It's way too risky. but buying a house is basically the same thing, except it's even harder to sell if things go south. Even ultra-wealthy people like Jeff Bezos and Barbara Corcoran have chosen rent. Yes, Barbara, the real estate queen from Shark Tank, has chosen to rent, not because she can't afford to buy, but because she values flexibility and understands that tying up money in a primary residence isn't always smart. Real estate can be a good investment if it's generating income, but the house you live in, that's usually not bringing in cash. It's draining the money. You're paying taxes, maintenance, insurance, and if the market crashes, your equity could vanish overnight. Wealthy people don't want their money locked in one illiquid asset. A $3 million condo in Manhattan might look fancy, but if it tanks in value, they're stuck. So instead, many of them rent luxury homes, keep their cash free, and invest in smarter ways. So, where do millionaires put their money? They put money into income-generating investments like stocks, bonds, or rental properties they don't live in, or in businesses that create real cash flow, or into the skills and knowledge that increase their earning power over time. But let's be clear, the rich aren't against homeownership. They just approach it differently. They do buy homes when it costs less than 25% of their income, or when they plan to live there for 10+ years, or when they already have solid wealth built elsewhere. They know it's a lifestyle choice, not an investment. The home is a reward for financial success, not the strategy to get rich. So, if you want to build wealth like the top 1%, focus on growing your income, investing in cash-flowing assets, and only then buy a home if it truly fits your lifestyle. Don't just follow what you've been told, run the numbers. Build wealth first, then decide where you want to live. Want more financial truths like this? Hit that like button, subscribe. And hey, are you currently renting or owning a house? Drop your answers in the comments below.